Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on everything you need to know as the clock hits 3 p.m. Eastern Time. Stocks are sinking today, and the combination of rate fears, geopolitical tensions, and a downbeat tone from major retailers, Walmart and Home Depot, both warning of tough times ahead.
Plus, Tesla shares are defying the odds again. The stock up over 60% this year, but a bear on Wall Street tells us why the company is not worth more than twice Toyota.
And the results are in. Companies are sticking with a 4-day work week after a trial run. But what would you be willing to give up to make that switch? We are going to have a lot to discuss there. All of you are weighing in out on Twitter there. But let's talk about the ugly market action that we are seeing this afternoon. With an hour to go in the trading day, we are looking at the worst day for the markets that we have seen since December, at least for the Dow and the S&P. You're looking at the Dow off 632 points right now. Nasdaq off just over 2%. The S&P off about 1.8% there. Some selling as we have been getting some mixed signals, some warning signs from some of the larger retailers. Walmart and Home Depot were both out with results. A lot of the movement today has to do with the guidance that we got from those two companies. But taking a look at the 10-year yield, that's up just about 12 basis points, levels we haven't seen since November. Taking a look inside the Dow, some of those individual movers. I mentioned the losses that we're seeing in Home Depot. That stock off just about 6% there. Walmart, though, now holding on to gains up just about 0.5%. Taking a look at the sector action, as we do see red across the board. Consumer staples, energy, the best of the worst performers here. Consumer discretionary, though, off just about 3%, as we did get those disappointing outlooks, I think you can say, from Walmart and Home Depot, Dave.
Yeah, and interesting to see how the market absorbs them, too, as Walmart fell precipitously on the news and then just began to come back throughout the day towards the close. Big retailers casting a shaky outlook on the state of the consumer headed into 23. Walmart says it expects adjusted earnings per share to decline over the next year, a stark contrast from the upbeat hopes of Wall Street analysts. Here's what Walmart CEO Doug McMillon said about the health of the consumer.
I think you can see it in the mixed impact. Customers are still spending money. When you think about our guidance and the place we positioned it, it's obviously not as clear to us what the back half of the year looks like as what we're experiencing right now and the momentum that we had coming out of the fourth quarter. But that's the way we would characterize them. They're making choices. We expect that to continue through the year.
And take a look at Walmart's e-commerce growth. That sales segment, 17% up the fourth quarter compared to 8.3% growth for U.S. same-store comp sales as a whole. Interesting to see that breakdown, not necessarily following along the trends. But when you listen to their CFO this morning, two things come out in terms of you look at the big picture. When you zoom out a little bit, he says that the consumer is really pressured, and on the macro, they are very cautious. And that's why they're projecting not a great number for 23. But when you look at the share price, come back, and as that bad news was absorbed, not as bad as initially feared.
Yeah, not as bad. I think there's lots of questions out there about how exactly Walmart is going to handle the next couple of quarters, because yes, they are seeing their consumer be pressured. On the flip side, they are seeing higher prices from some of their suppliers. Procter & Gamble, Unilever, saying that they will continue raising prices this year, putting Walmart in a pretty tough spot because they have to decide whether or not they are going to pass that higher price along to the consumer. If not, then of course that would further pressure their margins here going forward. The trade down, though, is something that we started to notice going back to last year. Certainly seems like that has continued, with grocery, that division being a short standout here for the last several months for Walmart. Grocery sales increasing in the low 20% basis on a 2-year basis. So take a look at that type of growth in the grocery division. More and more people are choosing Walmart as they are having to make those tough choices of where to spend and how to spend their money.
Yeah, it was interesting to see them increase their market share in grocery, in particular because the higher income households are beginning to trade down to Walmart. That, to me, above all else, was the most surprising thing from the report, because we knew that people are spending less on goods. They're not going to buy the TVs. They're not buying as many gifts. We knew they're going to buy grocery, and that's what's going to sustain them. But surprising to see those higher income income households trade down to Walmart.
It certainly really tells us a lot about the macro environment that we are in right now. Let's talk about Home Depot because it's the worst performer in the Dow today. The move lower, just around 6.5%, coming after its disappointing results, projecting revenue growth to be flat in line over the next year. Their CEO, Ted Decker, saying on today's earnings call that, quote, "We expect this to be a year of moderation in demand for home improvement. While we don't love the moderation, you can't fight the tide with spending going back to services, people traveling and whatnot." Very similar to the trends that we've been talking about now, Dave, for quite some time. And there was a massive boom during the pandemic. People were putting a lot of their spending into renovating their homes, into making some of those home improvements. Now they'd rather go out to dinner than do that, it seems like.
Well, largely speaking, you could argue they're done with that too. I think that's part of what you're seeing in Home Depot. People spent that money. They did update their homes. They were home, after all, for 2 years, stuck at home, and now they want to get out. But looking again, zooming out with Home Depot, this is now the 7th straight quarter that they've seen declining transactions. But what's almost always made up for that is the increase in your average ticket price. So transactions were down for Home Depot 6% in the quarter, but average ticket price was up 5.8%, almost the same number. Really, and the question is, when you look at that number, is that inflation based? Are people spending more because they're buying more things at Home Depot, or is it simply inflation is the only reason they are putting up the number that they are? And that's, I think, the trend that you're seeing. Really, it's inflation keeping them hanging on.
Yeah, it certainly does seem like this. Well, the muted outlooks from Walmart and from Home Depot certainly having an impact on the broader market today. We're looking at losses across the board. The Dow off 625 points. You're looking at the S&P off nearly 2%. The Nasdaq, the worst performer of the three major averages. Let's talk about all this with Tom Hayes, a Great Hill Capital chairman and a managing member. Tom, it's great to have you back here on set. So let's start first of all with just the retail portion of it. The earnings that we got out this morning from Walmart and from Home Depot. Some worrisome trends there. What's your takeaway?
Well, I think the lower end consumer at Walmart is running out of their savings. We still have $1.4 trillion of excess savings, but they are running down. They're going now to basics versus discretionary products. They're shifting from discretionary products to services, as you saw. But the silver lining that very few people are talking about is as these people run out of savings, what's happening is they're going back to work. And we saw in the jobs report a post-pandemic record in labor force participation rate of 62.4%, which is great for the Fed because the Fed can get the slowdown two different ways. The slowing in wage gains, they can collapse the economy, which would cause a lot of people to get unemployed, or more people can go back to work and you can get more supply of labor, which creates a ceiling on wages. And I think that's what we're seeing, and I think that's the silver lining. As for Home Depot, actually the entire top line miss was attributable to the collapse in lumber prices year on year. Excluding that, they would have beat on the top line as well. And I think this is the quarter. If you're a CEO, you have an incredible opportunity to manage expectations down and then beat through the back half of the year. So I think a lot of CEOs are doing that. We did see throughout this first quarter earnings period a lot of the word resilience, unexpected resilience of earnings and results. And I think that managing those expectations is the right thing to do. But I do think in terms of the general market, it's time for the bears to curb their enthusiasm. Why? Because markets don't top when managers are in record cash and overweight bonds relative to equities. You know, managers today are the most overweight bonds relative to equities than they were since the pandemic lows and since the great financial crisis lows in 2009, March of 2009. And those are just not the conditions to get a top in the market. But where we are is an 18.5% rally off the October lows, and we're just consolidating in a normally seasonally weak part of the year. The second 2 weeks of February historically is a very weak part of the year. So expect a little bit of consolidation, use it to find some bargains and opportunities, but I wouldn't throw the baby out with the bathwater here.
I'm glad you mentioned the lumber prices down 50% year over year. You're right. That was something that really took a bite out of Home Depot. Don't want to counteract the positive Fed news that you mentioned there, the labor force participation rate, but both Home Depot and Walmart are increasing wages. Doesn't that counteract any good news that the Fed might see?
In the short term. So we've had the benefit of the commodity prices coming down. We've had this lagged overweight owner's equivalent rent, which anyone who looks at the granularity of inflation knows that in May, June, and July, those numbers are going to start to collapse. Why is that? Because new leases, new rents, commercial and residential, are coming down. It's the old leases working on a lagged basis that have a significant weight in the inflation indices that are holding the thing up. So we're seeing this stubbornness narrative persist. I think as we get to May, June, and July, we're going to see it drop like a rock, and people aren't prepared for that. You know, we had a 25% peak to trough correction in the S&P last year, a 35 peak to trough in the Nasdaq last year. That priced in a lot of bad news this year that we're seeing. We're seeing a slowdown in earnings, we're seeing earnings taken down, and that's what the market does. Since 1950, the market bottoms 6 to 9 months before earnings bottom, and that's why we think the October lows are in, and that's why we've been bullish the last few months when we've been on the show. And what we also think is going to be a surprise is, so even if you think earnings are going lower, it's still time to be in the stock market. And now we're going to start to discount 2024. We've just finished 2022 earnings. We're not interested in that. 2024 S&P earnings are still $250, which means today we're trading just slightly below 16 times forward earnings. So
particular sectors you're bullish on before we go?
I think right now for the nervous Nellies, you want to have a little bit of defensiveness, wait for this to come in a little bit. We like Amgen. We want to have some exposure to biotech, okay? Biotech, more deals are going to start to get done. Pharma has tons of cash on their balance sheet. They have to buy the growth. One name we like is Amgen, is trading at 12.5 times forward earnings. They've compounded capital, return on invested capital, over 20% for the last half a decade. And the story that I love is the biosimilars. They've got a drug now that's going to compete with Humira. Humira is a $90,000 a year drug for rheumatoid arthritis. They're producing a biosimilar for $40,500, and they have a slate of another half dozen of those drugs coming out throughout this year. So we like Amgen at this multiple, and we like Centene. It's a health insurer. They do 65% Medicaid, 30% Medicare. That business is growing by 20%, trading at 10 times forward earnings. So these are defensive, safe stocks until the dust clears and we push higher. But with everyone in bonds, maximum pain is that we do push higher, and that's usually what happens when no one expects it. We don't top when everyone's in bonds. We top when everyone's in equities.
I hope everybody's taking notes. That's a lot you just threw at us. The kitchen sink came at us, Tom Hayes. Good to see you. Great Hill Capital.
Thanks for having me.
Always a pleasure, sure. Thanks for being in the studio. All right, now let's get you up to speed on Tesla, trending ticker on Yahoo Finance today. The stock moving down more than 4% today. Up, though, almost 70% this year so far, defying the odds after that rocky 22. And continued issues in the new year. Joining us now with more on this is Craig Irwin, Roth Capital Partners Senior Research Analyst. Craig, good to see you, my friend. You've got a neutral rating, an $85 price target. Why? And what do you make of the rally so far with Tesla this year?
So Tesla had some pretty violent moves to the downside last year. A lot of that was due to Twitter, and people really wanting Mr. Musk to focus his time at Tesla. Okay, he's going to spend more time than we like at Twitter, but Tesla's getting the right attention. So you've seen the value come back into the stock that came out primarily because of Twitter. The negative revisions to forecasts, expectations of 1.5 million being brought down to 1.4 million. That's still some pretty amazing growth. These guys are category king in the EVs. So, a lot of people want to own Tesla, but, we're bearish on Tesla. We see Tesla's a great company, but we think, there's going to be some real winners. The 100 or so EV models are supposed to hit the road this year. Many of those will be just as compelling as the Lightning or the Porsche Taycan, or, pick your car, right? Kia's got some great cars that are selling well. The Mach-E. Tesla's going to have some real pressure in the back end of this year, just like they faced in the back end of last year. And, that is going to impact margins. Now, margins have been overlooked for the near term. We're going to have some chunky margin pressure, and everybody's waving that away to buy back into the stock, just trying to pick a bottom. Our view is, we should be cautious, and you're probably better off in some of the other names in the space, given that, there will be multiple winners in, a category that, is inevitable.
Well, Craig, let's talk a little bit more about two pieces of things you just said. One, the pressures that we could see on margins. How much pressure do you think we could potentially see? And then you said that Tesla, compared to some of the other, what you're calling winners out there, who do you think is going to beat Tesla?
Yeah, so a lot of the benefit that's come back into momentum in the stock is price cuts, right? A lot of people jumped in for price cuts. So people that are buying on price cuts are not exactly prone to option things heavily. So, you're mixing towards a lower margin crowd of buyers with an already margin direct price cut. So I think we're probably looking towards, more like 1,000 basis points in margin degradation over the next couple of quarters instead of, basically 500, 600, 700. That's heavy pressure. A lot of people want to look beyond that and say, wave it away, because they've done a great job on margins, but not so great if you take out the ZEV credits and all the other credits. And then you factor where the mix is going to go in 24 and 25. They have to launch the mini car. That's going to be a fundamentally lower margin car. And all their vehicles are starting to look pretty long in the tooth. So that also doesn't speak highly of attractive margins going forward. So, yes, it's a growth stock. It's valued like a growth stock, and they have got growth going again, and they deserve credit for that. But I think that they're going to have a hard time really sustaining a multiple over the longer term, particularly given that the competition is looking very credible.
You had me at Ford F-150 Lightning. That's always how you get my attention. But when it comes to GM versus Ford in that EV space, how has that narrative changed given the recall there at Ford? And how do you think that story plays itself out this year? EVs are tough, right? This is new technology. There's a lot of learning that happens. We would prefer that none of it really makes its way into the public. I mean, I guess Tesla just had a fairly chunky recall of its FSD, full self-driving. I think of that as a misnomer. But the reality is there's learning that goes along, after these vehicles are launched. Fortunately, very little of it is catastrophic lessons. Most of it is fairly low cost to address. It doesn't bother me. I've driven an EV now for the last couple of years. My car's had a couple of recalls. It doesn't bother me. I just kind of accept this the way that we do when, there's recalls of the combustion engine vehicles that we own. And many of those do have recalls to address issues that, the OEMs would prefer never happen as well.
All right, so maybe a bit of an overreaction. Then Ford shares off once again today. Craig Irwin, great to have you. Roth Capital Partners, Senior Research Analyst. Thanks so much. Well, we are just getting started here on Yahoo Finance Live. Coming up, we get an on-the-ground look at what's happening with retailers with the CEO of shopping mall owner and operator Mesa Ridge. Plus, gas prices holding steady over the past month, but will it last? We will bring you the latest forecast from a Gas Buddy. And Coinbase releasing its fourth quarter results after the bell today. We'll break those numbers for you as soon as they come out. You can see the stock off nearly 4% ahead of that report. We'll be right back.
The talk has gone from hard landing to soft landing to now we're in this discussion about a no landing, which to me, I guess I'm just on a plane forever.
No landing is basically to take off on the metaphor about an airplane, and it just means that the economy's not going to slow down. If it continues to grow, the Fed has no reason to cut rates.
A hard landing, what is it? Well, this is where a recession takes place, where the Fed tightens so much that it creates a recession. A soft landing, this is where inflation is tamed, it is coming down, but perhaps not as many people need to lose their jobs as expected. A no landing is where the economy continues to grow, but inflation is not tamed the way the Fed wants it to be.
No landing is the new buzz phrase.
Do you see a no landing scenario playing out in the economy?
It's a great expression that we've coined recently. Here's what I think the problem is with that. Inflation that stays elevated, it's problematic and unacceptable for the Fed. Higher inflation for longer is not necessarily consistent with a no landing.
What does that mean economically speaking?
If you're talking about what it means to the average person, it's a good thing because that means we're not going to get the recession that everyone's been scared about. The economy is more resilient, and that means that we've got more room to grow going forward.
There's plenty of technical reasons why this market's rallying, but it's really all about the less bad fundamentals.
How should investors be positioned for that type of scenario?
What a lot of advisors are saying is don't operate on your stomach. Make sure you're allocated. The big thing is be diversified we've had a home country bias, and we've had way more invested in the S&P 500 than should be from a diversification standpoint.
Retailers are betting big on the return of in-store shopping. Recent data out from Coresight Research finding that major U.S. retailers opened more stores than they closed in 2022. Now, this is the first time that this has happened since 2016, the latest sign that the death of brick and mortar may have been greatly exaggerated. Let's talk about all this. We want to bring in Tom O'Hearn. He's the CEO of Mace Rich, which owns and operates shopping centers here throughout the country. Tom, it's great to have you. So certainly we talked a lot about maybe the death of brick and mortar, maybe the death of malls over the last several years. It certainly seems like that tide has shifted. What are you seeing? What are you hearing from your tenants today?
Well, you're right. The demise of the A-quality regional mall has been greatly exaggerated. And where we're really seeing it is in retailer demand. We're seeing demand like we have not seen since before the great financial crisis. 2022, for example, was a record year for us. We did over 1,000 leases, over 4 million square feet. It's a tremendous amount of retailer demand, and it's coming from a lot of interesting non-traditional categories. You know, we're seeing co-working coming into the malls, multifamily residential, high-end fitness, new entertainment uses, office towers, electric vehicle makers are starting to take a fair amount of space in our malls, and it's not just Tesla. So the malls are becoming a place to be. They're exciting, and the consumer has certainly come back with a force.
Has the consumer come back, or have malls just evolved? Because we just spent 15 minutes talking about how consumers have shifted their spending from goods to services. Do malls actually reflect that trend?
Well, we do, because we provide things beyond just the traditional mall apparel and footwear uses. Today, it's a lot more food and beverage. Office components are part of it. Multifamily entertainment, for example, is a much bigger component than it was years ago. So it's bringing in more people, more energy. One example I can give you is we recently signed a deal with the Arte Museum, which is going to go in the third level of Santa Monica Place here in Southern California. They're going to take 48,000 square feet that used to be a theater. They're going to repurpose that space and basically create a digital art gallery. And they expect to bring in 1 million visitors per year. I mean, that's a tremendous amount of energy and traffic to the third level of a mall that, frankly, wasn't seeing that level of activity coming from the theater operator.
Tom, when it comes to consumers, obviously they're out there looking for experiences. Maybe that's why they're going out and shopping in person after shopping online for a while. But some of those macro concerns that we have heard about this earnings season, are you seeing any signs of that, just any signs of distress from any of your tenants in terms of people backing out of deals?
We have not. I mean, we've certainly been cautious about that and have an eye to that. We're sensitive that could happen given the macroeconomic situation that we find ourselves in. But the consumer has proven to be incredibly resilient. I mean, coming out of COVID, we expected that, but it's continued. And in fact, even January reported good, strong demand from consumers. So we're not seeing the retailers back off. We're not seeing the new uses back off. The leasing demand is still there. And, the proof is in the sales, and the sales numbers have been good. Like 2022, we were up 7%, and in January, we were up 3%.
Really fascinating trend, Tom, coming out of COVID when everyone, to your point, predicted the death. You mentioned something that caught our attention. There was an article in the New York Times about people building upscale apartments at or near or actually in malls. Where are you seeing that? Do you think that accelerates?
I do think that accelerates. We're seeing it. In fact, we're doing it at Kierland Commons in Scottsdale. We're adding 110 luxury apartments to that project. And it's going to add not only the right kind of activity, it's going to add additional people. It makes it a more interesting site. And really what we're seeing is that A-quality regional malls are moving away from being malls per se, and they're becoming town center where people come to not just eat and shop, but also to live, in many cases to work. And it's going to continue to happen. At Flatiron Crossing in Broomfield, Colorado, we're planning a 330-unit luxury apartment complex. So we have more and more opportunities throughout our portfolio to repurpose former department store boxes and create multifamily and office, as well as hotels.
And a view of the Flatirons, Tom. I've been there. That is my home. That is my school. What a beautiful site. Tom O'Hearn, Macerich CEO. Really interesting conversation. Appreciate that.
Thank you.
Coming up, the debt ceiling debacle. One banking giant says some investors are already pricing in the risk of the U.S. defaulting on its national debt. We'll discuss how likely a default is next.
Congress is in a fight over the debt ceiling. Republicans and Democrats must raise a $31.4 trillion debt limit by this summer or risk defaulting on debt payments. Democrats want to raise that ceiling without conditions. Republicans, though, want to negotiate over spending cuts. There's a new note out from Goldman Sachs revealing some investors are cutting their debt exposure, pricing in that risk. Here, we want to bring in Yahoo Finance's Rick Newman for a little bit more. And Rick, DC doesn't seem to be too worried about hitting the debt limit. It looks like investors, though, are becoming a little bit more concerned.
Do we really have to keep talking? All right, I know we do. I know we do. Okay.
We've got a couple months to go, Rick. You got it. Yeah.
It's just going to keep
going. Up the, yeah.
Yeah. So everybody on Wall Street wants to know what kind of impact is this going to have on markets, and of course it depends how far we get to actually the U.S. defaulting. And so Goldman Sachs done some new research to say, we see a couple of tremors in a couple parts of the financial system. One of them is a group of stocks that is overly dependent on U.S. government revenue, government contracts. That's like infrastructure companies, aerospace and defense. And those stocks are slightly underperforming the S&P overall. So that suggests there's a little bit of a discount to those stocks for now. And then the other segment of the financial markets is credit default swaps. CDSs are these sort of insurance products against relatively short-term U.S. debt, like one-year Treasury securities. Those are going up in price, so it's costing more to insure securities that might mature around the time this financial dislocation, in theory, could happen. So two small signs that financial markets are starting to get a little bit worried, and this is beginning to get priced in. So the question is, how much worse could it get? And it could get a lot worse if 2011 is a template for what happens next.
The question is, what can convince Rick that this is
deal.
I will be terrified. I will be genuinely terrified when you're scared.
Look, it's totally real.
I will be locking
It's totally
myself.
real. The reason it's tedious is it's just a man-made problem.
I know.
I mean, we're doing this to ourselves.
I'm just saying that leadership battle in the Republican side of the House made me second guess any certainty.
That's right.
Out of Congress. All right, we also want to ask you about President Biden marking 1 year since the Russian invasion of Ukraine. That's coming up on Friday. He made a very discreet trip to Kyiv on Monday. Today, he's in Poland reiterating U.S. support for Ukraine.
1 year ago, the world was bracing for the fall of Kyiv. Well, I just come from a visit to Kyiv, and I can report Kyiv stands strong. Kyiv stands proud. It stands tall. And most important, it stands free.
So how significant is the trip, Rick? And is there any reason to think we're not going to be sitting in the same spot next year talking about year two?
I think Biden's trip is really significant, and we want to ask ourselves, how significant is it for us? Let's think about how significant it is if you're in Ukraine, and especially if you're a soldier fighting this war, and the President of the United States has come to your country at some risk to himself. He's in a war zone that is not controlled by American troops, the first time that has happened maybe ever. That is got to be a huge boost for Ukraine. And he's basically sending the message, we're sticking with this. Of course, Vladimir Putin, the Russian president, is outraged. That's why Putin, has said we're pulling out of the nuclear treaty and all other types of threats. I think the way you phrase the question, when will this end, is a good way to phrase it. Where will we be 1 year from now? I mean, this war is not going to end anytime soon. It's possible this war could be over within a year. If it is over within a year, it would have to be that Russia has lost and in some measure pulled out or made concessions that are solid enough to get at least end the fighting there. There's also a considerable chance this could drag on for quite some time. The Korean conflict in the 1950s, the war, it was a war, is a template for that, 3 years or more of fighting with no conclusive outcome and still no end to that war formally today. So it's going to be a mess for a while.
Yeah, it feels like the beginning of a years-long slog, unfortunately. Rick Newman, senior columnist, good to see you, my friend.
Thanks, guys.
It's a great shirt.
Thank you.
Fantastic shirt, Rick. Coming up, Molson Coors is trading higher on otherwise dismal day for stocks. Find out what investors like about the beverage company's fourth quarter earnings report. That's next.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Dillard's, Apple, and Molson Coors. Kicking off with Dillard's, a huge drop that we are seeing in that stock today, the biggest intraday drop that we've seen in months. Now, this comes after the department store operators' gross margins contracted in the fourth quarter, driven by weak sales at the start of the holiday quarter, which of course then led to higher markdowns. You're looking at a drop of just about 17% right now. Net sales of $2.13 billion were essentially flat from a year ago, but just missing the street's estimates. Now, Dillard's also announced plans to close 3 locations during the current quarter. Those stores are in Florida, Nebraska, and Arizona. We're seeing some concerns reflected in some of the competitors out there, some of the other larger retail names. You're looking at Macy's, Nordstrom, and Kohl's all trading to the downside today. And of course, also has to do with some of the earnings results that we got out before the bell here, Allie. And a lot of people are really just trying to figure out the strength of the consumer, the risk that higher prices pose to the consumer, and how much the consumers are going to be spending, quite frankly, over the next couple of months.
Yeah, and this Dillard's report does make me a little nervous when we do hear from Macy's, Nordstrom, Kohl's. They'll report next week, really capping off an earnings season that's been so up and down. And as you were saying, I think once we get those results, coupled with what we saw from Dillard's today, I think it will provide a bit of a clearer picture when it comes to the state of retail and obviously related the state of consumer. But Dillard's, in addition to battling that gross margin miss, it's also battling a downgrade from JP Morgan on the heels of those results. JPM downgraded shares to underweight from neutral. So it's clear that these gross margins headwinds, that could be something that continues for this company and something to continue to watch on the street.
It's interesting. We're talking in part about some mall anchors, and we just had on the Macerich CEO earlier in the program. And my feeling going in was, how is this guy possibly going to show us numbers where malls are growing? Well, malls are evolving because they know what those headwinds are in terms of those mall anchors, those traditional retailers, and they are pivoting to services, which tells me enough about the consumer and that shift from goods to services. Sorry to make the little bit of a parallel pivot there, but it is an interesting trend that we're seeing at malls across the country.
Yeah, it's a big inflection point. And, you know, speaking of headwinds, it's not just malls dealing with that. It looks like not even Ted Lasso can save the day here, because my triple play is Apple. Shares are slumping today, roughly in line with the Nasdaq Composite's 2% drop on the heels of a new note from UBS. The bank saying Apple TV Plus adoption appears to have stalled in the U.S., with just 22% of iPhone owners subscribe to the streaming service. Now, those numbers are based on an annual UBS survey. They are in line with pre-COVID results, but slipped compared to 2021. And guys, it's not just Apple TV Plus, Netflix, Amazon, Prime Video, Hulu, all seeing declines in iPhone penetration since 2020, but HBO Max has actually seen some pretty solid results. And Dave, I know you're a big fan of some of the Apple TV Plus programming. Huge. So I'm curious to hear what you think of these results and whether or not this is maybe an indication that you really need that deep library, a lot of original programming to keep users interested.
This can offer a counter opinion, because I think Apple's content spend is about a third of Netflix. I think what they're doing is really targeted spend in the content space. I don't know about you guys, but when I get on Netflix, there's just a sea of stuff. I don't know how to find anything. I end up getting back off. No one can tell me what to watch. But on Apple TV, it is much more targeted. Yes, 2 of my favorite shows, the 2 best shows on TV, I believe, Ted Lasso and Shrinking, are there. They don't buy a ton of stuff, but the stuff they do really fits a certain thread and serves a certain type of audience. I think both those shows will do well. Ted Lasso's coming in here. And then Friday, MLS, Major League Soccer, starts. Another targeted buy, small live sports buy. And I think I'm really curious to see how well that does. A niche soccer audience comes aboard, fits my trend of targeting programming.
It does fit your trend there. And I am on board with Shrinking. You recommended that to me. We started watching it. I do love it. But I would have to agree, if you do take a step back, it doesn't simply have the content library, obviously, that some of its competitors have. Whether or not that is a strategic move, like you're saying, I think we'll find out here over the next several quarters. What also stuck out to me in this note here from UBS was the risk of churn when it comes to Apple TV Plus, because the lack of subscribers there that have the auto renewal, just in terms of every month. Only 51% of Apple TV Plus subscribers utilize that auto renewal feature, which is about 10% to 15% less compared to some of its competitors out there. So you have to think, if you think about every single month whether or not you are going to renew, it's very, very smart personal finance wise. But obviously for some of these streamers, that could be a huge risk going forward.
Interesting to watch. My play is Molson Coors, the stock spiking on better than expected Q4 earnings. The beer giant topped earnings per share by 23 cents and just narrowly missed on revenue estimates at $2.63 billion. The company does expect sales to increase in the low single-digit range in 23 and is bullish on its lower-priced brands, saying in the press release, quote, "We have powerful core brands across our global markets that are seeing renewed strength, with Coors Light and Miller Lite in the U.S. posting their strongest combined full-year dollar share performance in a decade." That is a really surprising revelation. Jefferies analyst Kevin Grundy reiterating a buy on the stock with a $69 price target. You can see shares popping on the day more than 3%. They were up 6% earlier and have fallen a little bit. But any good news in the beer sector right now is very welcome for a battered industry, in particular those with exposure to the hard seltzer, which is flatlined.
Yeah, certainly. We saw the problems that Boston Beer has because of seltzer, obviously, last week. But Jefferies, going back to what you were just saying in terms of their price target there, they were saying that while it wasn't an extremely solid report, it was much better than feared. And we're starting to see that kind of creep in to these earnings reports, the analyst reaction over the last quarter, that if you clear that bar, because so much of these headwinds have been priced into a lot of these stocks, that seems to be enough, at least for now, and why we're seeing that pop in shares
Yeah,
today.
I was going to say that. It seems like investors, analysts are really focused on the outlook, on the guidance. And if you're able to, better than feared, if you're able to surpass that, you're getting rewarded.
Earnings really have shifted to almost entirely the guidance.
Yeah, all the macro headwinds,
yeah.
you know, that's
And
the
light
focus.
beer, a huge hit. Who knew? All right, well, coming up next, we haven't seen much volatility in gas prices over the last couple months, but how much longer can that last? We will get the latest expectations from Gas Buddy next.
This coming Friday marks 1 year since the Russian invasion of Ukraine. And while the devastating humanitarian and economic impacts have spread far and wide, one peculiar result can be seen at the pump. The average price of a gallon of gas is now down 13 cents from a year ago, according to AAA, averaging $3.40 per gallon today. Let's discuss why and where we are headed with Patrick DeHaan, Gas Buddy, head of petroleum analysis. Good to see you, sir. How do you account for that number down 13 cents since the war began?
Well, I think there's a lot of certainty now, even though amidst uncertainty over how the war could continue to unfold. We're now 12 months into Russia's war in Ukraine, and a lot of the initial fears have not been realized. That is, the flow of oil from Russia does continue, though. Of course, there have been some challenges, a lot of sanctions, Russian promises to cut production, and overall as well, some help from the Fed, which is trying to restrain trying to restrain inflation by raising interest rates, thus acting to cool off consumption. And we are in the time of year that consumption is much weaker. So we've seen gas prices now cooling back off after jumping in late December and early January, as it was related to that cold weather that we had that really inundated refineries with shutdowns and cold weather related issues.
So Patrick, here we are today at $3.40, the national average for regular gas today. What do you think that number is going to look like as we head into the summer months?
Well, I think it will creep lower here over the next couple of weeks, as we still are in the time of year that demand is rather anemic. But in March and lasting through Memorial Day, I would expect some more fireworks to emerge. Now, all of this really not considering China and the reopening of their economy, which has really been slow as COVID cases have surged. So there's a lot of wild cards here, but the average increase between March and Memorial Day is in the neighborhood of 35 to 85 cents a gallon. So I do expect that we'll move higher. Much of the nation now is going to be starting the transition to more expensive summer gasoline in March. And with refineries also starting a big maintenance turnaround season, I think that will eventually lead to rising prices.
You have any thoughts on the plummet of natural gas, how long it will continue?
Boy, for natural gas, certainly being helped by lower than expected consumption in the U.S. We've had some cold weather blasts here and there, but overall, Mother Nature's been very favorable. And of course, a lot of a skirmish ahead of the winter last fall was to fill inventories. U.S. inventories have been adequate, and part of the reason is, of course, Freeport LNG's downtime. But now with their facilities back online, now with the closing innings of winter here, things are looking much better than we had initially feared. And I think there may have been an overreaction to natural gas, but be that as it may, natural gas, the question is, when could we see a one handle on natural gas?
Yeah, that chart is shocking. Real quickly, before we go, I've always wondered this about you, because you know more about gas than anybody I know. Do you drive an EV?
I don't drive an EV. I drive an internal combustion engine. You got to still drive internal combustion if I'm going to be a petroleum analyst.
Okay, I always wondered that about you. When you pivot, we will know. You tell us, right? Patrick DeHaan, good
That's
to see you,
right.
man.
I will do that.
Check out
Thanks.
Gas Buddy. Appreciate it. Coming up, a 4-day work week seems like a pipe dream for most of us, but new research suggests it may be something more companies should consider. We'll tell you why after the break. America is burned out. A recent study from Aflac found that nearly 6 in 10 U.S. workers are experiencing at least a moderate amount of burnout. That's an increase of more than 50% from 2021 and a similar level to peak pandemic when we were all freaked out. But there is a better way. Much like the Beatles, Harry Potter, and James Bond, it came from across the pond. The UK conducting the world's largest ever 4-day work week trial, and the results were overwhelmingly conclusive. Less is more. Say it with me, Shauna. Less is more.
I like it.
90% of the British businesses say they'll continue the trial. 30% say they'll make it permanent. Dive deeper inside these numbers, nearly half of the companies said their business productivity remained the same, while a third said it improved. 15% said it significantly improved. I'm no math major, but that leaves just 5% who felt a 4-day work week was less productive. Employers were happy, so what about employees? Well, nearly 40% of the 2,900 felt less stressed, while nearly half reported improved mental health, with 37% improved physical health. They finally found time to go to the gym. I searched this report with a fine-tooth comb. I couldn't find the downside to the 4-day work week. But like Marmite, black pudding, and Harry and Meghan, not all things British are cool here. So it's time to test the less is more theory here in the United States. Shauna, what do we think?
I am all about testing the less is more theory here in the U.S. I would love to give 4-day work weeks a go. It was interesting when you said just how many aspects of their lives employees reported improvement when it comes to mental health, when it comes to sleeping, all things that we know are so important when it comes to productivity and obviously the end result here for the companies. Dave, we also asked our viewers what they thought. We put out a poll asking what people would give up for a 4-day work week. It is important to point out that the study that we were just referencing, those employees did not give up anything. They still received 100% of their pay. But from our questions, 19% of you said that you would take a cut of about 10% of your salary. 28% said a week of paid time off. Another 28% said no remote work. 25% though said nothing. I'll keep 5 days. I want to talk to that 25% because, Dave, you make a very compelling case and a very good case. If productivity does not decrease, if the eventual revenue output of a company does not decrease and employees are happier, it improves retention, and it seems like a win-win for everybody involved.
Let's point out this UK study, they did not have to take a pay cut. They did not have to take less PTO. They did not have to make any sacrifice. And I think there are ways to actually work the same. Some have made it 4 12-hour days. So you're technically still going to work the same in the end. I think that would be the preferential model if you ask me. Work the same amount of hours, but do it in 4 days. We acknowledge doesn't work for this job. We have a 5-day program, but I would like to see this tested more in the United States. I thought you might take issue with Harry and Meghan not flying here in the United States.
I do take some issue with that.
That's just my personal bias.
I do take some issue with that. Yeah, okay, but I do very much.
I'm tired of them. I'm sick of them.
Are you tired of them?
Enough with them.
Okay, I liked it though. I don't know.
But the 4-day work week.
4-day work week is here to say something that we would love to adopt from across the pond there. All right, well, coming up, we are counting down to the closing bell on Wall Street. It is a 4-day work week this week. Stick with us here on Yahoo Finance Live.
All right, just a couple of minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down some rather brutal market action. Nice
Yes.
sweater, man. I like the sweater jacket combo.
Thank you. I'm going to show you some green, but we don't have a lot to show here. This is the worst day that we're looking at and probably not going to change of the year for not only the Nasdaq, but also the S&P 500 and the Dow. And here's the Nasdaq Composite intraday. You can see we are at session lows right now, so it looks like that stat is going to hold. Now, let's take a look inside the market. All 13 sectors in the red, but what are we looking at here? The mega cap sectors, which are comprised of XLY, that's consumer discretionary, houses Amazon, XLK, tech, we know that, industrials, as well as communication services, has Meta, Verizon, as well as Netflix. All of those are underperforming to a huge degree here. And you take a look at some of the leaders. Wow, look at ARK. ARK is down 6%. That's their innovation fund. MJ, that's a cannabis ETF, that's down 5%. Retail 5%. Meme stocks almost 4%. Home builders right there. Internet stocks over in China, followed by chip stocks here in the US. You look anywhere and it is really a bloodbath. And Nasdaq, as I've been saying, has been leading this year by a large degree. Well, now it is leading the way down. Take a look at some of these results here just for the day. Roblox down 8%, Shopify down 5%, Square down 4%. And then we take a look at the meme stocks, really not doing a lot better. But I will say AMC is a standout, up 16% today ahead of its earnings in a few days. Might be next week. Don't quote me on that. But maybe some excitement there. Can't see it just about anywhere else. Here's your closing bell, guys.
All right, that wraps up the selling action that we have certainly seen today on the street. Dow closing off nearly 700-point drop there. S&P off just about 2% flat. The Nasdaq closing off 2.5%. Taking a look at some of the biggest movers, some of the biggest stories of the day. We got to start with Home Depot because shares finishing in the red, the worst performer inside the Dow with a drop of just about 7% as the company projects no sales growth this year in 2023. The home improvement store also highlighting today a new $1 billion investment plan that will boost its minimum wage to $15 an hour. This brings Home Depot in line with some of the other larger retailers out there, including Amazon, which already pays workers a $15 minimum wage. Walmart recently saying it's going to boost its minimum wage to $14. So obviously coming at a cost here from all of these retailers, specifically here, Home Depot, that $1 billion cost there. Getting mixed reactions from the street, but Dave, taking a step back, it just highlights the labor shortage, the issue that's facing so many of these retailers and what they need to do, the lengths that they need to go in order to attract workers and keep the ones that they have.
Yeah, look, we're seeing it in the biggest retailers in the country. Walmart's average pay now will be $17.50. You're seeing it at Lowe's, Home Depot's biggest competitor. You're seeing it basically across the board because the lowest unemployment rate in some 50 years, such a tight labor market. Until that dynamic changes, which is what the Fed needs to see, it cannot change. I don't know what Jerome Powell's going to do to break that cycle, which is what he believes he needs to do to get inflation back anywhere near that 2% target. But although we say wages are increasing, they are not growing as fast as inflation. I think we're at 4.4% in the last 12 months in terms of hourly wage growth. That's much less than the prices have increased 6.4% year to year through January. So yes, they're coming up, but inflation is outpacing those wage gains. Tricky story in terms of the Fed because you want these workers to make more money. They need to make more money to live. Not the story that Jerome Powell needs to tell.
Yeah, they certainly do. And obviously it's a hard situation for everyone to be in. And specifically, it's hard for the Fed, just given the fact of the dynamics at play right now. In terms of the street's reaction to this, Walmart was out with a note saying that outlook for flat 2023 comp sales, that was, quote, better than feared. Another common theme that we've been talking about a lot. But when taking that wage investment into account, quote, it's hard to say that Home Depot took the downside scenario off the table. So we're looking at a drop here with Home Depot of about 7%, that $1 billion investment into wages clearly having an impact. That coupled with the no sales growth forecast here for 2023, Dave.
Really interesting to see that drop for Home Depot. Okay, Microsoft is gearing up for a showdown with EU regulators over Microsoft's proposed acquisition of Activision Blizzard. The closed-door hearing will see Xbox chief Phil Spencer and other senior Microsoft executives argue the case for the $68.7 billion deal that seems like it just may never close. Yahoo Finance's Dan Howley has the details for us. Dan, it hasn't looked good for quite some time. Has anything changed in that dynamic?
Yeah, big time. We've seen some major companies agree with Microsoft to deals to get the company to put Call of Duty on their platform. So they announced this $69 billion deal last year, January 2022. They haven't had much movement, as you said, Dave. We've seen, though, regulators with a lot of movement. The FTC sued Microsoft to block the deal. The UK's competition authority has put forward a draft of what it believes Microsoft should do to alleviate concerns that they have about antitrust problems, including divesting itself of Activision Blizzard or Call of Duty, or just killing the deal entirely. And the EU is looking at this, and that's where we are looking today. Now, the movement that we saw today was that Activision Blizzard, Microsoft, they entered into an agreement with Nintendo to provide Call of Duty on those platforms for 10 years. They also entered into agreement with NVIDIA to provide Call of Duty on NVIDIA's own platform for the coming years. NVIDIA has its own cloud platform. This whole argument is essentially about the cloud and Call of Duty. Microsoft has its own Game Pass service. They're doing well. They have the market share lead in terms of the cloud, but the cloud is still very nascent. We don't know how it's going to eventually shake out still, but they're crushing it. Sony, the biggest objector here, not doing nearly as well as Microsoft in terms of the cloud, and frankly, as far as offerings go. And so they don't want Microsoft to have Call of Duty to be able to kick Sony to the curb and say, look, if you want Call of Duty, you got to get it here. Why Call of Duty? Why is it so important? Because the last one, Call of Duty Modern Warfare 2, sold $1 billion in sales in just 10 days on the market. If it can get it in the cloud, that's even better for Microsoft. So we have NVIDIA initially objecting to the deal, now saying that they agree to it because of that assurance from Microsoft. Whether Microsoft can enter into a deal with Sony remains to be seen. Don't forget, Sony is one of the top video game companies in the world by revenue. If Microsoft does get Activision Blizzard, it would be among the top three alongside Sony and Tencent.
Well, lots of questions about what exactly the future looks like when it comes to Microsoft and Activision, that merger there. But NVIDIA, like you're saying, lending that support. I also want to talk to you more specifically about NVIDIA, because once again, it's a top trending ticker here on Yahoo Finance today. We'll get their quarterly results after the bell tomorrow. Today, we saw a drop, but we certainly have seen a run up in the stock price since the start of the year. What are you expecting to hear?
Yeah, I think, the big conversation is going to be around AI. Obviously, that's where NVIDIA has been making its bones as of late. It was previously only making, or not only, but making the majority of its money through gaming. And it's still doing well as far as gaming goes, though not nearly as well as it did during the pandemic. As far as early numbers that we're expecting, we're looking at a potential $1.6 billion in revenue from the gaming division. Last year, the same quarter, Q4, they brought in $3.42 billion. So a massive potential drop. And look, we saw that in Q3 as well. We saw gaming revenue down 51% in Q3. And, as far as the data center, though, that's expected to improve. As we talk about inflation, we talk about rising interest rates, and some companies potentially pulling back on their broader spending as far as IT goes. For NVIDIA and the AI story, it's all the better when we have conversations about things like OpenAI's ChatGPT, Microsoft's Bing, Google Bard. Those all need to be powered by graphics cards, essentially. They're high-powered. They're better at handling these massive tasks than your standard CPUs. And so that's good news. The broader discussion about AI, not necessarily those companies, Microsoft, OpenAI, and Google, but the broader conversation. It pushes people more into discussing AI, and that is much better for NVIDIA. So, we're looking for some improvements to year over year to the data center business, but a steep decline in the gaming business.
Yeah, the prevailing wisdom out there on the street has been that NVIDIA will be the primary beneficiary of OpenAI's ChatGPT. Of course, that is probably well down the road, but certainly a tailwind at some point. Dan Howley, good to see you, sir. Thank you. Coming up, we'll have Coinbase's fourth quarter earnings for you. Stay with us.
The latest real estate report, GDP, key earnings, and a looming anniversary, all coming up this week. Here is what you need to know. New home sales numbers are expected on Tuesday and Friday. Mortgage rates are ticking up again, putting renewed pressure on the housing market. Expect sales and prices to reflect continued weakness in the sector. And how's the overall economy doing? We'll find out Thursday with the latest GDP report. U.S. economic growth is expected to have slowed to 2.9% in the fourth quarter.
It might not be her father, but you were someone's.
HBO's hit series, The Last of Us, boosting the bottom line for Warner Brothers Discovery. We'll see by just how much on their earnings call Thursday. Also serving up earnings, Domino's Pizza and Carvana. And Friday will mark the one-year anniversary of Russia invading Ukraine. A human catastrophe that sent global markets into a tailspin, drove up energy prices at the pump and in homes, created a supply chain gridlock across the EU, and led to food insecurity around the globe. As world leaders call for an end to this war, the fighting continues, including a new Russian missile barrage in recent days and the global economic uncertainty that is far from over.
It is almost time for spring break. There's some good news. And according to the travel app Hopper, the price you'll have to pay to get away, much like your kids' Cancun hangover, is going to hurt. With searches for March and April, trips outpacing overall searches by 10%. Let's talk about it with Haley Berg, Hopper lead economist. Haley, it is going to hurt. How bad? How much are prices up for spring break at this point?
If you're flying somewhere domestically in the US, you can expect to pay about 20% more than you paid for spring break last year, but only about 5% more than pre-pandemic. Keep in mind, this time last year, prices were very, very low. Spring break wasn't hot in the mind. Omicron wave was still running through the US. So a little bit of sticker shock, but not so bad when you compare to pre-pandemic prices.
Haley, what is demand like? And in terms of where people are going, some of those top destinations, what are they?
Demand is surging for spring break, and even some travelers starting to think about bigger trips in the summer holiday season. We saw a 25% surge in demand to destinations in Mexico, Central America, and many of the Caribbean islands. We're expecting to see much of the spring demand headed to those warm weather beach destinations and some to Europe. That's where most of the demand is headed right now.
Yeah, Vegas is just exploded all the way back and beyond from pre-pandemic. Hotel rooms, we showed the graphic coming in. How much are they up, and are there alternatives for those folks that are traveling this spring break?
Hotel room prices nationally are up well over 50 and 60%. Hotels in those big cities like Las Vegas, Miami, we've seen price increases 80% or higher in the last few weeks alone. Prices are really being driven up by higher costs, but also super high demand. A lot of travelers are looking to book accommodations on trips this spring and summer, and some of these big cities are where we're seeing the biggest demand increases, hence these incredibly high prices.
Haley, what if you haven't booked your spring break travel yet? Is it too late, or when should people be booking?
If you're planning to go somewhere internationally for spring break, you should be booking now. Prices will really only rise between now and early May when we get into the summer season. If you're headed somewhere domestic in April, you can wait a couple of weeks, monitor prices, but you should expect to book between now and really the second week of March. If you're thinking about a spring break trip, you really have to start planning now. About 80% of Hopper customers haven't booked their travel yet, even though spring break season will be in full swing starting the end of next week.
So obviously, earlier the better as to when you book, but how about where you book? Are there places you can go where you can save a few bucks?
Absolutely. And it's not just those lower demand destinations that are going to offer deals. There are going to be deals available to all top destinations. I'm still seeing airfare, Boston to San Juan, Puerto Rico, under $200, LA to Cabo, under $200. The best way to get those deals is not necessarily where you go, it's when you go and how far in advance you plan. If you can fly midweek, you can save about $100 per ticket on those domestic flights. $100 to $200 on international. So be as flexible as you can with when you go, a little bit flexible on where you go if you want to get the best deals, but there are still a lot of very good low prices out there for travelers who haven't booked yet.
Are prices down in any aspect of travel?
Car rentals. So if you are going on a road trip or thinking about turning your vacation into a road trip, car rental prices are actually down about 15%. The car rental industry has done a lot of work in the last year to move their supply of cars around, focusing on building up their fleets in these warm weather destinations that are just persistently high demand coming out of the pandemic. So we've seen a lot of relief in rental prices in some top markets like Las Vegas, Miami, parts of Florida that are just hugely popular at this time of year with Americans.
Okay, our heads exploded when you told us how much flights have increased in the last year, let alone the last couple of years. So give those shoppers, those travelers, some tip in terms of when they look, what types of websites, what's the best way to save 50 or 60 bucks on a plane ticket?
The best way to save is to plan ahead and use an online travel agency like the Hopper app for a few reasons. One, we're going to aggregate all of the potential flight and hotel options for you into one place. Oftentimes, apps in particular are considered a closed user group. That means that airlines, hotels, industry-wide, we can offer prices that you might not be able to find elsewhere. Think about hotel geofenced rates. Hotels often offer lower prices to members of their own communities, a staycation rate. You can find those available on the Hopper app. We can create what are called hacker fares, 2 one-way flight tickets, maybe booked on different airlines, that combine to make a cheaper price than you can find on one single site. So using an online travel agency is a great way to give yourself access to all of the rates that are available, as well as do some price tracking. So on the Hopper app, we'll monitor the price of a hotel or a flight for you, notify you when it's time to book, answer that age-old question of when should I book my flight? Should it be on a Tuesday or should it be on a Saturday or any day of the week? So a lot of advantages and easy, pretty hands-off ways to save for travelers if you use an app or an online travel agency like Hopper.
All right, a lot of great tips there. Haley Berg of Hopper Lead Economist, thanks so much.
Great.
We want to get to Coinbase, the stock up here in extended trading, up just about 1%, so pairing some of its initial gains on the heels of its quarterly results. Taking a look at some of these numbers, revenue for the fourth quarter coming in better than expected. That's one of the big drivers here in the after hours action. You're looking at sales of $629.1 million. That beat the street's estimate of $586.2 million. Drilling down into trading volume, transaction revenue, trading volume did fall as expected during its most recent quarter, falling to $145 billion. Estimate was for $149 billion, so $4 billion less than what the street was looking for. Transaction revenue coming in a bit light, $322.1 million. The estimate was for $326.5 million. The company, though, saying that it is operating towards its goal of improving adjusted EBITDA versus 2022 levels. They also said that they do not expect to meaningfully increase their headcount versus what we had seen here with the company. Now, in their shareholder letter, the company also saying that 2023 will be a year of regulatory focus, and they believe that Coinbase is in a position to benefit from that new environment. But again, the revenue beat is one of the reasons why we are still seeing that stock barely holding on to gains in extended trading, up just about 1% right now. We'll have more for you when we come back. Muted outlooks from Walmart and Home Depot raising some questions about the consumer and spending patterns. Now, we will get more data on the consumer this week when we hear from Etsy and eBay. Both are set to report their quarterly results. Here to discuss what to expect from those two names, as well as what we've seen more broadly speaking from the consumer-facing names so far this quarter. We want to bring in Nick Jones, an equity research analyst at JMP Securities, a Citizens company. It's great to have you here. So let's start with eBay, because I think some of the results here from Walmart, from Home Depot this morning, raising some questions about what we could potentially see from other consumer-facing names. What are you expecting to hear from eBay?
Yeah, so we think 4Q results are actually going to look pretty good. The beauty of online companies is you can get a lot of third-party data and track them, whether it's site visits or app downloads. So we think eBay is actually looking pretty good into 4Q, and even the early data heading into 1Q, I think actually looks relatively strong as well. So what'll be interesting, particularly for eBay, is if they're kind of focused categories where they're trying to get consumers to spend a little bit more money versus kind of transactional users. They're not spending as much. If they can kind of keep those users coming back and spending more, I think that's really going to be in focus, and maybe where the data breaks down a little bit. But so far, eBay looks like it's going to have a solid 4Q, and 1Q so far looks like it'll probably be in line with expectations, but we'll see tomorrow.
Yeah, if there's one positive to take away from Walmart, it's that increase in e-commerce that they saw, far outpacing same-store sales. What about your expectations for Etsy?
Yeah, same thing. 4Q looks pretty strong. Looks like we had a strong holiday season. The data suggests 4Q is going to come in line with consensus expectations. And we track the data monthly, and so far into 1Q, the data actually looks like Etsy's pacing ahead of expectations. So another one where we think the trends look pretty resilient. Etsy's really been one of the strongest performers in e-commerce. Their upper funnel trends have been really resilient, still growing year over year, where many companies are declining, like Home Depot or Walmart. So we think Etsy's in a similar situation where 4Q is going to look decent, and 1Q commentary is probably going to be pretty strong as well.
Nick, we did see some pressure on Etsy stock not too long ago following that report from the short seller Citron, raising some questions. He was very critical of the operations, also saying that Etsy was one of the largest platforms for counterfeit goods. How do you look at that? What was your takeaway from those accusations?
Yeah, so we did some digging and looked back at some historical precedent and legal cases. eBay's actually faced this several times over the years. And almost always it's judged that the trademark holder is required to police it. And as long as the marketplace or platform takes things down and is proactive, they're really not held liable for that. And even some of the judgments that were made are relatively small in real dollar terms. So even if I'm wrong here, the financial impact Etsy would be quite small. And Etsy they're very proactive. They have a lot of automated algorithms to try to find counterfeit items and remove that. They even put out a report every year. So, we don't see that as a huge threat to Etsy at all.
And when we put these two companies together, Etsy and eBay, what will that tell us, if you will, about the consumer?
I think it will just show that at least e-commerce still shows some resilience so far, and the consumers are going to continue to look for unique items, and e-commerce platforms generally provide that option that you can't get in brick and mortar. So, we think it'll show that consumers are still preferring e-commerce. Broadly, though, I think there still are concerns around where spending is going to go. Saving rates are down so far. So where will PCE trend kind of throughout the year, particularly as the Fed reacts to better jobs and the PMI numbers today? We'll see. Of the two, we think Etsy is the one to own. They're, they have a robust platform touching a lot of end markets, really strong brand recognition. We really think kind of the tactical picks will come into play here, and we think Etsy is the one to own in e-commerce.
All right, Nick, we got to switch gears here a little bit. Talk about Carvana, because it is a stock that's usually one of the top trending tickers on our site. I know you cover the name. Shares are off, 92% over the past year. You have an outperform rating on the stock. Just you and one other analyst has the equivalent of an outperform rating on Carvana. What do you see that most other people are missing right now?
Yeah, so right now there's kind of maximum fear that Carvana may go bankrupt, and there's a lot of reasons for that. They made an acquisition, they have high interest expense, they are burning cash still. We've done some math, we've done an analysis. We don't think they're going to run out of cash anytime soon, and that will likely get to a more favorable market where they could go raise capital or refinance debt and kind of navigate near-term headwinds. So kind of the kind of first factor here is will they or won't they go bankrupt? We don't think they're going to go bankrupt. So if you don't think they're going to go bankrupt, it's a very strong consumer offering that will continue to gain share over time. They just kind of got to get through near-term narrative challenges, if you will, as far as their balance sheet strength. So we think people are being overly punitive on their bankruptcy risk. We don't see them going bankrupt. We don't see them running out of cash. We think they have plenty of options to kind of navigate near-term headwinds. So because of that, when you see the stock down at these levels, we think it's a very compelling price point to enter the stock.
Wow. You also covered Zillow, who recently reported earnings. What did they tell you about the online environment in real estate and what's to come overall in the real estate sector?
Yeah, so what was really interesting about the recent call was more first-time homebuyers came back, where kind of in the first half of 22, there was a lot of cash buyers. So Zillow benefited by more first-time homebuyers coming back, which is encouraging because that's a lot of the millennial group that are still looking to buy homes. All that said, 1Q isn't really the floor yet in terms of how maybe bad the residential real estate environment could get. So as rates keep going up, that's going to continue to pressure the ecosystem and transaction volume. So all said on Zillow, really strong company, but there's a lot of headwinds, and they're a very mature company. So we see them potentially having some pressures as we get through the year, and really got to keep an eye on what's going to happen to mortgage rates and whether or not kind of these millennials and other groups of people who haven't really bought their first home yet come in and are willing to pay these interest rates and the prices that are still out there. Because if you look at the data, the prices really haven't pulled back yet. They pulled back somewhat, but not as much as you'd expect given the rates.
So you think the worst is still out there, still ahead of us?
Potentially. Could this be sideways? It may not get worse. Right now, it does not seem like it's going to get much better. So it seems like sideways to worse is probably the outcome from here.
Interesting read. Nick Jones, good to see you, sir. Thanks so much. Appreciate that. Coming up, more Americans are turning to side hustles to bring in some extra cash. We'll tell you why after the break. If you're looking for a way to make a little cash during these tough times, this side hustle could be the answer. More Americans are hopping on the gig train this year. Let's discuss with Yahoo Finance contributor Vera Gibbons. Vera, nice to see you. Beyond the obvious inflationary pressures, what's driving the trend?
Well, a number of different factors. Obviously, inflationary pressures is a big one, and we are seeing people take on multiple gigs, not just one or two, but one person I spoke to has 7 income streams running. So inflation is a large part of that equation. But also, there are other factors. I mean, this whole decentralization of life is going on. Working in an office is an antiquated concept. You know, I don't know too many people who are working that way these days. They've got the hybrid schedule. So that's a factor as well, as is the fact that we are up against a looming recession. And when you're worried about a recession, your natural inclination or your impulse is to actually go ahead and make more money. So there are several factors contributing to the rise in side hustles. Inflation is the big one, but other factors driving the trend as well.
As far as generation goes, who is doing the side hustling here?
Yeah, you always think, oh, it's the kids doing it. It's the millennials, it's the Gen Xers. But, you know, that's not necessarily the case. We're also seeing some baby boomers jump in, some pre-retirees, some retirees jump into the gig game. There's a bucket of people who are doing this. There are people who are looking to find a gig that's an offshoot of their career. There are other people looking for gigs that don't require any special skills. That would be the drivers, food delivery type gigs. And then there's a third bucket of people doing this. And these are people who are just pursuing their passions. Maybe they have something they've always wanted to do, and now's the time to do it, whether that's teaching music or coaching their kids soccer or whatever the case may be. So people are doing it for a variety of different reasons, and it's all ages. What's interesting too is that I think the type of gig is really changing. You know, 5 years ago, it was just, delivery services, Uber, Lyft, grocery delivery. But now we're seeing more people really leverage their skills into lots of opportunities, and those opportunities can be pretty lucrative. So this is really where the growth is, specialized fields, and you can do everything from marketing to law to journalism right from the comforts of your home. So if you can piece together 2, 3, or 4 little side gigs and have several employers, that's where the opportunities are, and that's really where the growth is today. That's one of the big differences.
I'm sure there are dozens, hundreds of viewers wondering, how do I go about this? Because you always hear about it. How do I go about finding a side hustle?
This is where the challenges are, specifically if you're looking for those specialized ones. Unless you want to just go and be a driver, you really have to hone in your contacts and see where those opportunities are. But you know, it's interesting too. Like I feel like this is sort of the wave of the future as life does become more decentralized, and people are worried about the recession. This is what they're going to do: find opportunities, word of mouth, get back to networking, which makes it a little more difficult now that you're not doing anything in person. But I think that the full-time job, or the concept of the full-time job, is sort of dying, if not dead already. In fact, one person I spoke to said it is probably dead already, given where we are and given the acceleration of the decentralization and the cultural shift that's underway. Having one employer is just not really going to continue to happen. And he thinks that 2023 is where we're going to see really the gig economy really explode.
Kind of piecing together 2, 3, 4 jobs to make up one. That is frightening for our future. I'm curious, and not to put you on the spot, but predominantly are we seeing these people who are pursuing and doing these side gigs, are they home hybrid workers?
Most of them are home hybrid workers. That's an interesting question. Yes, most of them are taking on these opportunities from home. There's a lot of online opportunities. There are a lot of online platforms that they're finding opportunities on. That is where the growth is as well. That's correct.
I've been taking notes because I need a little side gig. If you have any in mind, Vera, you give me a text.
There you go. Well, you can always hone in on your TV abilities and your journalism skills and find something else you can do from home.
Yeah, I'm not driving Uber, man. I would be no good at that. No good at all. Vera Gibbons, nice to see you.
5-star guy?
I'd get bad ratings. I'm not a nice driver. All right, thanks, Vera. Coming up,
Thank you.
Coinbase, let's see what those shares are doing after hours, after a mixed report. You can see shares down more than 2% after hours. We'll hear from an analyst on why shares are falling after the break.
Coinbase reporting a loss here for its fourth quarter, but revenue coming in slightly better than expected. We saw a revenue of $629.1 million. The street was expecting $581.1 million. Transaction revenue off 86% year over year. Let's talk a little bit more about this report. We want to bring in Moshe Katri, Wedbush Securities Managing Director, Equity Research covering IT services and payments. Moshe, it's great to see you again. So first, we initially saw a pop here in extended trading following this release. Now shares are in negative territory. What's your takeaway, and also about the volatility that we're seeing here in extended trading?
Not surprising. I would say the numbers were mixed, a bit better on revenues. Subscription and service revenues looked better than expected, a bit lighter on the profitability. Guidance for subscription for Q1 is actually up sequentially. That's probably a bit more of a positive than a negative. I just think there's a lot of kind of noise around in terms of, the regulatory part of the business. And I think that probably continues to weigh in on the shares in general until we get better clarity in terms of where the regulators are going to go. From our perspective, it just feels that this management team is doing all the right things. In terms of being able to kind of survive this perfect storm that we're seeing right now, and probably thrive just because they continue to operate in a very, very tough neighborhood. And at this point, it seems that this is probably one of the few players that's still kind of up there and, doing well.
They describe it as a year of regulatory focus, albeit one they can benefit from in the release. If you could talk a bit about that regulatory backdrop and how they could benefit from it this year.
Yeah. So the regulators will be focusing on a couple things: safety, security, and transparency. And from our perspective, it seems that they're doing really well in all of these aspects, if you will. There's no doubt that the cost of doing business will go higher. But on the flip side of it, this is a company that in 2021 generated north of $14 in earnings per share. So it kind of shows you what sort of leverage you have in this model if things stabilize and if we get better transparency and better visibility in where the regulators are going to go. And obviously, you're assuming here that you're not going to get through some sort of a black swan event where the regulators come out one day and say, hey, nobody can own, any sort of a crypto asset. But if we get some sort of stabilization, if we get some visibility on where the regulators are going to go, and again, you're focusing on three things, as I said: transparency, safety, and security. And these guys have, despite all these things that are going around here, most of their competitors are kind of crashing here, and the business is still here. And again, you can just look at what this management team has done. The focus continues to be on monetizing the retail part of the business, the institutional side of the business. When these guys went public, the biggest concern about crypto was that you will see trading fees or trading revenues compressing. That has not happened. And it just feels that you have an institutional base and a user base continues to be relatively loyal here. And that's why the business has been relatively sticky.
The Kraken settlement with the SEC, how does that impact Coinbase? And if you could weigh in on this whole discussion around staking that we are really hearing about pick up in recent weeks.
It's all about your ability to provide that safety net for investors. If you're able to kind of show the regulators that you have enough funding or liquidity to go through some sort of a cash crunch, I think you should be in decent shape. And that's how we kind of look at it.
Moshe, when it comes to regaining that trust, I think a lot of people are out there, many people that had been invested in crypto in the past ahead of this last crypto winter are staying on the sidelines, still just very hesitant about getting back in. What can Coinbase do, or what more do you think they should do, if anything, to help win back some of that trust?
We believe the regulators have to do more to get to those three aspects that everybody's going to be focusing on. When that gets resolved, I think that the rest is going to be pretty easy to go by, if you will.
Moshe Katri, we appreciate all that analysis, sir. Thank you so much. All right, we'll be right back after a short break.
Jeffrey Gundlach is the co-founder, CEO, and chief investment officer of DoubleLine. He's known across Wall Street circles as the Bond King. Gundlach first became interested in finance after watching that over-the-top 80s TV show Lifestyles of the Rich and Famous. He rose to prominence after predicting the 2007 subprime mortgage crisis and the global financial meltdown which followed. In 2009, Gundlach founded the fixed income money management firm DoubleLine, which quickly became one of the fastest growing investment firms in history. Today, DoubleLine manages close to $100 billion in assets. Gundlach is estimated to be worth $2.2 billion, and he's one of the biggest modern art collectors in the world. He donated over $40 million to build a new art gallery in his hometown of Buffalo, New York. As the reigning bond king, Gundlach is known to weigh in on just about anything affecting the economy.
The relationship between the size of the Fed's balance sheet and the market cap of the S&P 500 is what I call Gundlach's law of financial physics.
To politics.
The lack of cooperation in our government it's unprecedented, really, at least in my lifetime.
In 2022, increasingly frustrated with California's government, he moved DoubleLine's headquarters from Los Angeles to Tampa, drawn by lower taxes, less government bureaucracy, and a more friendly business environment. In the years since that move to Florida, the economy has soured on inflation and recession fears.
All right, let's take a look at what is trending after hours here. We have three names for you. We have Caesars, Palo Alto Networks, and also Toll Brothers. Kicking it off with Caesars, we're seeing that stock under a bit of pressure, off just about 1%. The company reporting a wider than expected loss. Sales, though, did beat for its most recent quarter, coming in at $2.82 billion. Las Vegas same-store net revenue was up 11% on a year-over-year basis, $1.15 billion. You're looking at gains of just about 5% over the last 3 months. Year to date, the stock has regained a lot of its momentum, up just about 23% as some of the buyers have come back into that picture. But again, in extended trading, Caesars off about 1%. Moving on to Palo Alto Networks, that stock up nearly 7% in extended trading. Adjusted EPS coming in at $1.05. Strong revenue, also bookings here, one of the big drivers in the after hours action. We've got revenue of $1.66 billion. Billings coming in stronger than what the street was looking for, $2.03 billion. Estimate was for $1.96 billion. Obviously, that's good news here for Palo Alto Networks. Year to date, you're looking at gains of just about 19%. Over the past year, though, the stock hasn't trended, I guess, the big takeaway, it's not too far from the flat line, although we have certainly seen a lot of volatility in that name over the last 12 months. Over the past year, you're looking at gains of nearly 4%. And let's round it out with Toll Brothers, the latest reading on the home builders on the real estate sector. We're looking at gains of just about 2.5% here in extended trading. Profit rising there, the company beating on both the top and bottom lines. We're looking at revenue of $1.78 billion. The estimate was for $1.74 billion. Adjusted home sales, the gross margin there also coming in better than expected, 27.5%. The estimate was for 26.7%. Over the last 3 months, looking at gains of just about 23%. Year to date, a little bit of shorter term chart there, gains about just around 12%. So certainly some buyer enthusiasm has returned to the home builders. And all in all, Dave, when you take these results and everything that we have heard from the sector and lump it all together, home builders, I think, are faring a lot better than many had initially feared.
Strangely. I actually thought they'd have a tough start to the year, but they have mostly started well, although all of them, really the big home builders, down today. Diving inside the release a little bit, contracted homes down 50% year over year. Homes in backlog down 32% year over year, but home sales revenues up 4%, largely because income from gross margins up 190 basis points year over year. And some interesting commentary from their CEO that really actually surprised me. Since the start of the calendar year, we've seen a marked increase in demand beyond normal seasonality. As buyer confidence appears to be improving, we believe the recent pickup in demand is a sign that the long-term fundamentals underpinning the housing market remain intact. So listen, that's just one of the big home buyers, but that is a pretty optimistic view at the big picture in the real estate market. All those dire predictions just never really came to fruition. And though you have conflicting opinions on whether the worst is behind us, largely speaking, it seems like they've all weathered the storm.
Yeah, they have weathered the storm, and they have pretty optimistic outlooks. You just mentioned the comments there from CEO Douglas Yearley, but also when you take into account the home builder confidence index ticking back up, a huge jump that we saw in the latest reading just really points to the fact that many of them are more optimistic about the improvement that we could potentially and hopefully will see within that sector over the coming quarters. Like you're saying, lots of debate about how big of a jump or how big of a, how quickly maybe we could regain some of that momentum. But it seems like the worst of it maybe hopefully has been averted, at least for now.
Yeah, but if you want one number that tells you the inventory story, contracted homes down 50% year over year.
Yeah.
All right, first there was Twitter, now Meta, social media platforms testing out subscription models to boost revenue. Meta announcing this weekend that it's copying, if you will, Elon Musk's Twitter Blue with a new service called Meta Verified. It costs users $11.99 a month for web, but the dollar figure you're concentrating on is $14.99 a month for iOS and Android for a verified badge. That's $15 a month on your iPhone. The perks are pretty similar to Twitter. You get a verified badge, protection from impersonation, increased visibility, and exclusive features. They say, like access to customer service. As one who is verified on Instagram, I can tell you there is no access whatsoever to customer service on Instagram. So it really comes down to that word visibility. Do you get a massive boost in visibility, Shauna? Because I don't think those content creators are overly concerned, or at least willing to part with $15 a month for added security. In other words, worried about someone else parroting your name and starting their own account. It all comes down to visibility. That's in terms of the user. The investor story, that's a whole other question.
Yeah.
Are they going to get more people on the platform here? Is it going to increase overall revenue? I think it makes more sense for Twitter because they already had the traffic. They already had the numbers. They wanted to get more revenue out of them, whereas my sense is Meta wants more people on the platform.
Yeah, exactly. And I think because of that, because we're having kind of a tough time just wrapping our heads around the exact impact that this could potentially have on Meta, we're seeing that also reflected in the street's reaction to this. On the one hand, you have CFRA, who actually has a hold on the stock, saying that this was a no-brainer as the social media-based firms dependent on ad space need to be a little bit more creative, need to come up with new ways there in order to diversify their revenue amid the challenging backdrop for the industry. On the other hand, Bank of America isn't necessarily as sold just in terms of what this could potentially produce here for Meta. And the big reason or the big issue that they potentially have is just the audience size, kind of similar to what you were saying, Dave, just that it could be limited by the number of creators and influencers on Meta's platform. I think the takeaway, though, is Meta is trying to be creative. They're trying to do something new. They're trying to generate a new avenue here in terms of revenue. I think it does make sense. Will it have as big of an impact maybe that Twitter could potentially see from theirs? Probably not, just given the fact I don't know how much appetite there's going to be, at least for now, from what they're offering, for what we know for this new service.
I think that price target is a little too high. I think for the ordinary average user, this is obviously going to be focused on content creators and influencers, because I think for the most of us would not pay $15 a month. I thought that number would come in, honestly, about half of that, somewhere between $7 and $10 a month to really get those numbers up. It comes at a weird time as they're just starting to get some traction on Reels. You can't help but wonder if this is at a strange time. If you're wondering, you have to be 18 years old.
Yeah.
So it doesn't, you can't buy it if you're 16 and 17. And those might be the people who would pay for verification. Yeah. And you are grandfathered in if you are already verified. They're not going to pull your verification. I'm sure you were concerned about that.
I was very concerned. Very concerned. So our influencer reputations, everything remains intact.
Secure. Okay, my stock to watch for tomorrow is Lucid. The electric vehicle maker reports its fourth quarter results after the close on Wednesday. Analysts are expecting Lucid to report a loss of 40 cents per share on revenue of nearly $315 million. One of the key things to watch will be the outlook for deliveries. The company already announced it produced 3,493 vehicles during Q4. Lucid shares are down 40% over the last 6 months.
All All right, all eyes will be on that report tomorrow, but that will do it for us today on Yahoo Finance Live. Thanks so much for tuning in and sticking with us. We'll see you right back here again tomorrow at 3 p.m. Eastern Time. Have a good night.